Hey team, what's going on? Corey Halliday here with the Cashflow Academy, and some of you have been asking for my secret option trading journal. I've created this over the last number of years. We've given it out to our students. Today we're going to reveal everything within that journal, how to use it, how to capitalize on reducing your cost basis, and how that can really motivate you to keep going with the process and keep owning assets. It is amazing. Make sure you stick with me. I'm going to explain how the journal works, how to use it, and how to download it directly from this YouTube video. So let's get into it. First, we've got to pick a stock, and I just chose PayPal. It's obviously been in a downward swoon. PayPal was spun off from eBay. They used to be within the eBay umbrella, and now PayPal trades on its own. eBay trades on its own. I guess that's been a few years, but PayPal stock has really struggled of late, and you can see the downturn that it's been in. Well, we would have to do fundamental analysis. We'd have to feel good about the business long term, about Venmo and all these things that they own. But if we felt like PayPal was an opportunity, this can be a good educational example. So we come into PayPal, and oftentimes what we do as option traders is we sell a put initially to acquire stock. And the reason we sell a put is we get paid premium. Now, let me give you an analogy. Most people think like, well, how do I pay off a house? You buy a house, you take out a 30-year loan, and you pay that off through blood, sweat, and tears, right? You trade in your time and your talents for a paycheck, and you send that paycheck for 30 years to finally pay this thing off. Well, that's great. Then you own the asset outright. But what if somebody could supply us with capital to pay off our investment much sooner? In other words, what if we bought little mini houses, aka stocks? Instead of buying a house, we buy PayPal. Maybe we buy a home builder, Lennar or DR Horton. The point is that we can own a bunch of little assets called stocks, but we can pay them off much quicker than 30 years, and we can do it by collecting premium. So this is the mindset I want to get people into, is we want to acquire assets. We want to own assets long term. So PayPal, if I sell a put less than 1 month away, it would pay me about $250 as the asking price. So we're going to collect a premium of $250 to make a promise in the future to maybe buy $6,000 worth of stock. Why 6,000? Well, we're making a promise for 100 shares. That's what one option contract controls, 100 shares. At $60 is the strike price. That's where we're striking a deal. So we're making a promise to maybe buy $6,000, but they're paying us the $250 up front. And we get to keep that $250 no matter what. Whether the stock goes up, sideways, down, we get to keep the $250. If we do end up buying the stock at $60 per share, is our cost basis actually 60? Well, we could say no. Our cost basis is 60 minus the $250 they paid, right? Or in other words, we collected $250 supplied to us by the market. So our cost basis is $57.50, $5,750 or $57.50 per share. It is reduced by the $2.50 premium we collect for selling that put. We make a promise, we collect the premium, and we get to keep that premium no matter what. So first principle, the market can pay you to buy the stock you want at a discounted rate. Buying here is better than buying at 60. It's a better price. And it's not insignificant. Let me pull up a calculator and show you that if we were to compound at that return, $250 on not even a $6,000 promise. It's a promise to buy $5,750 more. We only have to have $5,750 because they supplied us with $250 of the bucks, right? So 250 divided by 5,750 is a return of 4.3% in 1 month's time. Where else can you make 4.3% return on invested capital in 1 month's time. That's pretty solid. Now, I'm not suggesting that it's always going to track, you're always going to make this and never have to buy anything back. But theoretically, if we annualize that, it's a giant number, 52% annualized return. Now, it's not going to be that good, right? Sometimes we buy the put back, sometimes we roll it down, we make adjustments. But you can see that at 4% for 1 month that we get to keep no matter what, that's a good starting point. Then if we do acquire the stock, what we can do is go out and start selling covered calls. And if we get put the stock in December, we could sell a January covered call, and that one would pay us. I mean, that one is going for $370. And all of a sudden, you're starting to stack income. See how you made $250 the first month, $370 the second month, and you're chipping away at your cost basis. And that's what this journal does. This journal is a cost basis calculator. So let me show you how cool and powerful this is. Let's pull up a journal, and I have an example in here. I've been trading Constellation Energy. Now that's an expensive stock. That stock is $300 and some odd per share right now. I need to update this where it's at. It's at like $370 per share. My cost basis is much, much lower than that, of course. Now, here it shows you our cost basis is worked down to 310. How does it come up with that number? Well, let me show you. We input in the green, and then it will give calculations accordingly. So the only boxes you fill out are in green. Each one of these is designed to be one stock. So you would choose one stock and you'd fill out that journal. Here, we'd choose another stock, and as we're selling options and collecting premiums and reducing cost basis, we would fill out this entire section for that stock. A new stock, we'd come over here. Another stock, we'd come over here, and we could fill this out for each one. Let's show you how this works. So first I punch in the stock symbol that I'm trading. Then we don't buy the stock initially, so I'm going to leave that blank. We're going to sell a put, let's say. And we sold the 60 strike put, one contract, and collected $250, a $250 premium. See how it filled in the white boxes for you automatically. Now we're collecting $250. That cost basis, whatever cost basis we end up with, notice how it's minus $250. The calculator already knows, this journal already knows, the way we've built it, that our cost basis is reduced by the amount of premium. Now let's say that put expires worthless. We kept the $250. We sell another put in PayPal. This time, we sell the 60 strike again for maybe January, and we collect $3 of premium. Well, that's a $300 credit. Now our cost basis is going to be reduced by $550. Why? It's those two numbers combined together. We've collected $550 of premium. That's a reduction of $550 per share on 100 shares of stock, right? Let's say we do it one more time, and this time the stock gets put to us. We sell it, we collect maybe $200 in this instance. Now we're up to $750 in premium collected, and this time we receive the stock. So now we own 100 shares. What was the purchase price? $60. That's where we struck the deal. That's the strike price we were selling puts at. So we got put the stock. We bought 100 shares at 60. We put that in. Already the calculator shows that our true cost basis is $52.50. Why? Because yes, we bought the stock at 60, but the first month we had collected $250 in premium. The second month we had collected $3 in premium, and the third month we had collected $2 in premium. So our cost basis is what? Well, there's $550, $750, 60 minus $750 is $52.50 per share. How much money do we have in this deal? We don't have $6,000 in this deal. We have $6,000 minus premiums received. So notice we really have now $5,250. This total amount originally invested minus premiums is our new cost basis. You see how we're reducing cost basis quickly. Now, if we kept doing that, let's just punch in some premiums here. And let me just show you how quickly this can work. And let's just say we collected $2 in premium on each of these. Let's just punch in a bunch. If we did this for months and months, look at what happens. We're down to $1,450 cost basis. We only have $1,450 in this deal. We're almost to have paid off our investment. And how many months is that? Well, I don't know. Here's line 37 and this is line 16. So maybe this is about 21 months, less than 2 years, right? It takes you 30 years to pay off a house. How would you like to pay off a stock in, let's say, 3, 4, 5, 6 years, 7 years? The point is that as you pay off that asset, you no longer have any money in the deal. And the way we think about this changes our entire life. Because imagine if I just gave you a gift. Imagine I said, you know what? I'm going to hand you 100 shares of IBM. I'm going to give you 100 shares of Google. Well, first of all, you would love me for that. Secondly, you wouldn't be as worried about the stock because you got it for free. You have it outright, right? You're not worried about its ups and downs. You're like, hey, this was a gift. It's a free roll. When you pay off an investment, it's easy to feel that same way. When you see the cash flow coming in, you know that it's paying for itself. It's why real estate investors that buy rental properties and then they rent those out, that rent coming in is paying their mortgage, it's paying off the house, and they just don't feel stressed about it. And you can do the same thing in the financial markets, but the barriers to entry, it's so much easier to come up with a couple $1,000s to start to work at something like this than to do a real estate deal where it might cost you tens of thousands of dollars. So the barriers of entry to get into stock and option investing, especially options, where it's no debt leverage. We don't have to take on borrowed money. We don't have to take on debt, but we're still able to use leverage and use a small stick to move a big boulder. This is powerful. So this journal allows you to calculate that. Now, if you ever buy something back, if you ever debit, how do you put that in the calculator? You would just put a minus sign. So if we bought this one back for $2, I'd put -2, and then it would subtract $200 because we were debited. We had to pay to buy that option back, and our cost basis went up. If I -2 on this one, it's going to go up to $20.50, right? Or $22.50, because now we didn't collect a $2 credit. We actually ended up at a $2 debit. It's a $4 swing. So our cost basis goes up. Let's come down here. If I put in a -2 on a new line, this is $22.50. If I put in a -2 on a new line, it'll only go up 2. If I go from +2 to -2, it'll go up 4, of course. So when we're buying options back, if we have to do that, then our cost basis will go up temporarily, and then we can get back on track, start collecting those credits, and reducing that cost basis. And you can use this journal to track your cost basis on each one of these stocks that you're collecting premium in, and you're reducing that cost basis. And we've got a big long line of them. And you can download, of course, 3 different journals, 4 or 5, if you've got more stocks than are included here, and start tracking that cost basis. So as promised, if you want to download this trading journal for yourself, click in the description below. You're going to be able to go down there, download this Excel journal, get started with the journal with an awesome strategy that has an 80% win rate. 80%. Check out this video right here for an 80% win rate strategy. Check it out now. Go download that journal. Enjoy.